I think that if we go back in time and look at what we saw, for instance, when there was the escalation of the North Korea situation a couple of years ago, the market had much more concern, I think, around that particular situation than they do about the Middle East. And I think that goes to just the accommodative environment in which we sit. If you think about, things that haven't changed, the Fed hasn't changed. We've gotten a little bit of progress in China. And I think that you're actually seeing some strength in areas like energy and some of the defense companies, which, when we've been talking about this cyclical rotation, we've been talking about those names getting some strength. And so I think overall, as much as I would say that from a political perspective and from a country perspective, this would be a negative for us to engage in higher escalated tensions in the Middle East. I think from a stock perspective, I don't anticipate this being any sort of upending of the momentum we've had over the course of the last few weeks.
The market, Joe, is, kind of to Cramer's point this morning, it's by virtue of the activity in the market, it's telling you it doesn't think that there's going to be some massive escalation of tensions that, devolve into a full-fledged conflict. No, or the market would be down a lot more than it is following on where it was last week.
Price is certainly not reflective of what we read and watched over the weekend. I would agree with Jim's assertion on that. I also think, and to Tony Dwyer's point, Tony's referencing something that is not consensus at all coming into 2020. And I think sentiment is where I personally begin. I think of 2019. I think of a dramatic shift in sentiment. I think of the events of the last couple of days, and I think about the moderation of what was a very bullish sentiment for equities walking into 2020. What do I do with that personally? I know, Stephen, you suggested maybe you just stay inside the U.S., but for me, I want to rebalance. I want to reallocate. I want to question myself and say, did I have too much exposure to the U.S.? Yes, maybe I did. Did I have too much exposure to financials? To Jimmy's point on manufacturing, seeing the number that we did, that's a reflection, or it is reflected in lower yields. That's a problem for net interest margins. Am I overexposed to financials? I look at today, Scott, and I look at the conversation we've had in the last couple of days. My mega cap technology exposure, it's Apple, Microsoft. Well, in 2020, guess what? So far, Microsoft and Apple underperforming relative to an Alphabet or Amazon. Is it time for me maybe to take those positions and go there?
Let me ask you this. If there are other areas of the market that look vulnerable, which ones are they? Semiconductors are down today. You bought the dip.
Yeah, so I had a position in semis, both in Smash, SMH, which is the index, also in Skyworks. Bought a little Qualcomm recently. They're looking for a hockey stick return to semiconductor growth, particularly in memory in the second half of 2020. But I'm so bulled up on the technological advances we're going to see with 5G that you've got to be there. Now's the time. So
but that's true. But you can also have the view that I agree with everything that you just said. But the stocks have had such a run. The SMH has had such a good run.
That's sentiment.
I just can't. I don't think it's sentiment. I think it's fundamentals also.
Well,
I mean,
right. Bit of both.
Right. But,
is it vulnerable?
As I said, it's never where stocks have come from. Otherwise, nobody would own Apple.
No, I get it. But if you do believe that a correction is imminent or there's going to be a burst in volatility now because of what's happening in the Middle East, that, those are ground zero, so to speak,
right,
for areas that money would be pulled off the table quicker than others.
Absolutely. So I never equate volatility with risk. I equate volatility with opportunity to either sell or to buy. Volatility is not risk, pure and simple. But you manage a different book than I do. I just don't worry when stocks go down.
Also, the semis, and I've said this before, but it's worth saying again, they're not all alike, right? You've got a beta of 3 in AMD, you've got a beta of 2 in NVIDIA, and you got a beta of 1 in Intel.
Sure, but they are all alike in the set when you're buying the
direction's going to go. The direction is going to be the same in all. So wait, I think the point you're making is the direction is going to be the same for all of them. I agree. But if you have new money to put to work today, and you're worried about the things we're talking about, Scott, you brought up valuation with regards to Tony. I'm bringing up geopolitical risk. If you're worried about that, then you can take a smaller beta in an Intel. If you are, hell-bent for leather right now and you think that things are going higher, buy yourself some AMD and NVIDIA. Those are going to be 3 and 2 times what Intel does. But I'll give one other thing, and I'm sorry Shannon alluded to this, and it's right on the money. If you're worried about valuation and you're looking at energy stocks, that have 3, 4, 5% dividend yields, trade at book value, I know this is what you were saying. I mean, that's a pretty easy call to make as well.
And I wouldn't equate sort of selling, whether you're trimming semi or semiconductor exposure or some of the other large growth names that have done really well over the last year. I wouldn't equate that with necessarily needing to feel like we have to have a risk-off move. To Joe's point, you could just be seeing better opportunities outside of the United States, particularly against this dollar environment that we're seeing, the backdrop of a stable dollar, to be able to do some reallocation. So I don't think we have to call for this significant risk-off move to be able to see some reallocation out of some of these names that have performed really well over the last year.